I just wanted to illustrate how a margin call works for most people. It's very important for a CFD trader to understand how a margin call works so that you can therefore avoid one. Firstly, we have up the top is our account portfolio. Now this is really important because this will show you the figures that you need to monitor to make sure you don't hit a margin call. So as we've discussed in the blog, a margin call is when this free equity figure gets to 0 or lower, and that's when you technically have hit a margin call. Your GLV, for those who don't know, is your gross liquidation value. So if you were to liquidate all your positions at the current market price and walk away, that's what you'd have. And obviously margin is for any positions we're holding at the moment. P&L, profit and loss. So in this instance, we've started the account with $5,000 in cash. And the first position we've taken is we bought 1,000 BHP at $35. Margin being 5% means $1,750 has come out for margin, as we can see there, leaving us with $3,250 in free equity. So that's what we've still got available to trade on or to use for potential losses, etc. Again, then this is the figure to measure, to watch, I should say, and that's why we've highlighted it in red, just to make it nice and simple for you. Now, if, let's say, BHP goes up to $36, you'll see that our profit, our GLV, our gross liquidation value, because now that position's making 1,000, has gone up to 6,000. Our margin has gone up a little bit because the value of the position has gone up. But that positive $1,000 has fed into our free equity for us, obviously minus what's gone in for margin. And now we've got extra free equity to continue trading with, etc. Now, the opposite of this will happen when we incur a loss. So we just went up. Now, let's say BHP went from $35 to $34. Sorry, but P&L's not big enough, my apologies. So we'll see here that now we're running a $1,000 loss on this position. Okay, that $1,000 has come out of your free equity, it's come out of your GLV, and your margins decreased fractionally. Obviously, the price has gone down a little bit, and so now we can see that the free equity we had of over 3,000 is now down to 2,300. So we can see if the price of BHP keeps going down, the effect it has on our account. So our margin really doesn't change all that much, but you'll see our free equity's gone down dramatically, our gross liquidation value. So if we close this position now, we started with 5 grand, we'd only have 3 left. More importantly, our free equity figure is now starting to approach a dangerous level. So let's say we go down to 32 now. Again, now we're running a $3,000 loss, and our free equity is down to 400. Now what happens is, when this gets to 0, this free equity figure, our margin will still be there. So we've still got our margin or our safety deposit on the position, okay? And when free equity gets to 0, your margin will be exactly the same as your GLV. So let's have a look and see what happens if there was a margin call. So let's say BHP now gapped down to $31. We can now see what's happened. We've put in 5,000 to start the account, but we're now losing 4,000. So our GLV is still 1,000, okay? So we're still, if we close this position, would have $1,000 left in the account minus commissions, etc. But we can still notice here that our margin is actually now higher than our GLV. We actually need $1,550 to maintain a margin to keep this position. So our free equity is now down $550. It's into the red. So you are now in a margin call. Now to hold this position, we'd need to either instantaneously put in 550, obviously more, just in case BHP keeps falling, just to top up the account to get us out of a margin call. Okay, so 550 would be the minimum. If you plugged in 1,000 more into the account, it would get you back into 450 free equity. Okay, we'll still maintain the same position. But again, if BHP went down another dollar, you're back in the red 500. So you need to make sure this stays above 0. Any CFD provider can technically liquidate your position if you get to 0 or below. Some of them even higher if they want. Will be written into your PDS. So you do have to make sure you're very wary of this figure. A lot of people set alerts and so forth to notify themselves. But what I would do in this case, if you've got the equity, if you don't have the equity, simply close the position. You can re-enter BHP again, maybe when it settles down at a lower price or whatever stock you're in. Or I would just dump extra cash in there. Maybe throw in a couple of thousand. You know, you can look at worst case scenarios to where BHP can go before you want to maybe sell because you know it's a bad trade. And therefore you need to have enough free equity to cover that.